Hi everyone, welcome back to the podcast. Happy Tuesday, as I say. So today what am I going to talk about? I'm going to talk about 5 investment strategies the affluent and the rich use in India, which might be of use to you. I thought this can be something like a guideline which you can use, these 5 ideas, and without wasting much time, I'll jump right into it. In a diverse economic landscape like ours in India, interacting with affluent individuals who are wealthy and substantial figures offer intriguing insights. Drawing parallels between their investment strategies and adopting them as individuals such as us can be fruitful and beneficial for conventional investors like us. There's a distinction here. However, it's not strictly and exclusively in the realms of the wealthy. We can also take them and adapt them and use them in a broader populace, as they say, to elevate all of us out of the situations we are in life and become wealthier and freer, as I always want you guys to be. But here are these 5 strategies which I think broadly most wealthy in India use, and they managed to keep their wealth intact. Not only intact, they ensure their wealth keeps growing at a very good, alarmingly quick pace to some of us. First one is called utilizing losses for tax benefits. We have seen this happen from Donald Trump to everybody in the film industry. Some of us always wonder, why do these wealthy individuals, investors in India, go and put money into good, hard-earned money into movies which they know are going to fail? Because there's a strategy where you can take the losses you make and offset them into taxable income, and it's called leveraging your losses. They embrace the paper losses to mitigate tax liabilities and enhancing the availability of capital in the future for investment. Such practices align with broader strategies often used in companies to reinvest their profits into R&D and other developments to foster long-term growth. So this is not illegal. This is very much legal. It is a tax strategy which a lot of people use, where you write your losses off into your taxes so you can lower them, what tax has to be paid to the government. So individuals meticulously can plan their investment and strategies and expenditures based on this to maximize their benefits. This leveraging propositions is there in the Income Tax Act, and this is why my father will always say it's important to have 3 good friends in life. One is a lawyer, another is a doctor, and the third is an auditor. You should always have a good auditor as a good friend, because they would know the insights into this. Another thing which a lot of people do is, which is also legal, is incorporating legal entities to optimize tax liabilities. As an individual, you're only allowed to carry so much on your name before you have to start paying taxes. And as your levels increase, the amount of tax you have to pay keeps increasing. If you're employed in a company, there's very little you can do, because this is all taken straight out of your paycheck before you get your payment or your salary. But if you are an individual who's a businessman or an investor, you can set up these companies, as they call limited liability partnerships, LLPs, and they stand as separate individuals, and this structure can efficiently allow you to move your investments such that into these companies and reduce your overall tax liability and manage your taxes much better. For instance, business expenses, operational cost, and various allowances are given as deductions under Indian tax laws, and they can strategically be managed and optimized to reduce your income tax. Exploring diverse financing avenues. The rich in India often exhibit a nuance in keeping their investment flexible, in closing deals and navigating beyond traditional banking and financial channels. In Indian context, what can I say? This means exploring various lending and utilizing assets as collaterals, and even leveraging instruments in various vendor financing. So if you're a business person, if you need some finance for your next project, think of utilizing utilizing assets which are already there with you, and collaterals which are there which you can use in your business, and leveraging instruments which you already have to finance your next project. And think differently, think out of the box. This diverse approach, underscored by understanding this, can facilitate dynamic investment strategies, allowing you to maximize opportunities and minimizing risk and minimizing cost. One of the biggest costs in business is your interest or your debt, By lowering that interest cost in your debt, you may increase your profit margin and make yourself more profitable and more attractive for other investors to come and invest in your business. Maintaining liquidity through cash equivalents. What are cash equivalents? Cash equivalents is not keeping cash as cash in your bank account. Successful investors and business people in India maintain their liquid positions and ready to capitalize on emerging investments by keeping this cash, as they say, Anand says, not as cash, but investing them maybe such things as bonds. While bonds offer the flexibility of it being liquid, when you need to, you can change your bonds or your investments in bonds. And you can cash them, take them out and put them into stock market whenever you need. But at the same time, when you keep it in bonds rather than your savings account, it offers you much better interest compared to a regular savings account or even a fixed deposit. A fixed deposit might offer you a spread of 7-8% if you're a young person in India right now, but a bond can offer you maybe 9-10%. And with good tax management, like I said previously, creating companies and keeping your bonds in those company names, you can lower your overall tax burden. So this also makes sure whenever you need to move your funds back into something, when you see a great opportunity in the market, you can quickly liquidate these positions which you have maybe in bond or in gold and move them into these great opportunities you see in the market. So remember that. Make sure when you do say keep your cash liquid, that your liquid cash is doing something. Even Warren Buffett does this. He doesn't keep his liquid cash as just sitting liquid cash in his accounts. He buys T-bills or he buys other instruments which offer him returns till he sees an opportunity in the market. As all this what I've said so far, the most important thing, so at the heart of this strategy which I wanted to share with you is sticking to fundamental principles. Spending within your means, focusing on acquiring assets that foster wealth accumulation are the two most important things. Let me repeat this. Cut down your spending and invest in things that will help you becoming wealthy and rich. So these are the two most important things the most affluent and the wealthy people in India do. Any purchase or any investment they make sure it is something which they need to have, or they reconsider making that purchase. And the second thing is they'll make sure their money is working for them, at least beating inflation by a percentage or two. If you fail to apply all the other principles I was talking about, creating companies, writing off your losses, they all sound too complicated, and you don't have a great auditor who can help you out, at least stick to these two principles which I'm talking about, which is cutting your spending and making sure your money works for you. If you follow these two and are very disciplined about this, this is going to create unbelievable wealth for you in the long term. I hope the strategic insight which I gave you into why investment methodologies of the affluent and the rich in India is very important and something you can use. And I hope you found these lessons valuable for you personally. Thank you for joining me on the podcast today, and I'll see you on the next one tomorrow, which is going to be a Wednesday.